Their strategies for long-term wealth, building as practiced by the most enduring financial figures, are consistently misunderstood because people look for tactics where there are principles, speed where there is patience, and brilliance where there is restraint. Long-term wealth is not built by doing extraordinary things once, but by doing ordinary things correctly for an unusually long time, while avoiding the handful of mistakes that permanently remove most people from the game. This perspective immediately reframes the entire conversation, because the real challenge is not how to make money, but how to remain capable of making good decisions decade after decade. The first pillar of long-term wealth building is survival, a word rarely associated with ambition, yet central to every enduring fortune. Financial masters define success initially as not blowing up. They design portfolios, businesses, and careers around the assumption that bad years, bad luck, and bad decisions are inevitable. This assumption leads them to prioritize margin of safety, conservative leverage, diversification, where uncertainty is high, and concentration only, where understanding is deep. Survival buys time, and time is the raw material from which compounding emerges. Compounding itself is the second pillar, but not in the simplified way it is often discussed. Financial elites understand that compounding works on behavior as much as on capital. Small advantages in discipline, cost control, patience, and judgment compound just as powerfully as returns. This is why they obsess over fees, taxes, friction, and unnecessary complexity. Anything that quietly leaks value year after year is treated as an enemy. Long-term wealth is less about finding big wins and more about eliminating slow drains. Another core strategy is aligning risk with temperament. Financial masters do not copy strategies that look good on paper, but feel wrong emotionally. They know that a strategy you cannot stick with through drawdowns is not a strategy, it is a liability. Long-term wealth builders choose approaches that allow them to sleep, think clearly, and remain rational under stress. This alignment dramatically reduces the likelihood of panic decisions at precisely the wrong moments, which is where most wealth is destroyed. Time horizon is deliberately extended beyond that of the crowd. While markets obsess over quarters and headlines, long-term builders think in cycles and decades. This longer horizon reduces competition and emotional noise simultaneously. Temporary underperformance becomes tolerable. Social comparison loses power. Decisions are judged by durability rather than immediacy. By simply being willing to wait longer than others, financial elites access opportunities unavailable to those trapped by short-term pressure. Another defining strategy is selective aggression. Long-term wealth builders are inactive most of the time. They wait patiently, sometimes uncomfortably, for situations where risk and reward are meaningfully misaligned. When such moments appear, they act decisively, often with size. This pattern, long periods of restraint, followed by concentrated action, creates an illusion of boldness from the outside. In reality, it is the logical outcome of patience combined with preparation. They conserve energy and capital so they can deploy both when it actually matters. Long-term wealth is also built through ownership rather than constant trading. Financial elites favor assets that generate cash flow pricing power or participation in real economic growth. Businesses, real estate, and durable equities are preferred not because they are exciting, but because they allow wealth to grow without constant decision-making. Trading may produce income, but ownership produces endurance. Over time, the reduction in required activity becomes a strategic advantage, freeing attention for higher-level judgment. Equally important is simplicity. As wealth grows, financial masters often simplify rather than complicate. Portfolios are streamlined, business lines are narrowed, decision criteria are clarified. complexity is recognized as a hidden form of leverage, one that increases fragility without advertising its risk. By reducing moving parts, they reduce the number of ways things can go wrong. This simplicity supports consistency, and consistency is the engine of long-term results. Reinvestment plays a central role. Instead of maximizing lifestyle expansion, early long-term builders reinvest disproportionately during their compounding years. This is not asceticism, it is strategy. They understand that early reinvestment has exponential impact later. Lifestyle inflation is delayed not because they lack enjoyment, but because they understand timing. Wealth enjoyed too early often prevents wealth from becoming durable. Another overlooked strategy is reputation management. Long-term wealth is social as well as financial. Trust compounds. A reputation for fairness, reliability, and long-term thinking opens doors to better opportunities, better partners, and better terms. Financial elites are careful not to extract maximum value in ways that damage relationships. They accept slightly less today to preserve access tomorrow. Over decades, this approach produces opportunities invisible to purely transactional players. They also invest heavily in learning, but selectively. Long-term builders study history, incentive psychology, and systems, rather than chasing constant novelty. They reread foundational ideas and refine judgment incrementally. Learning is used not to predict the future precisely, but to recognize fragility and mispricing when it appears. This steady improvement in judgment compounds silently, showing up as fewer catastrophic errors rather than more spectacular wins. Perhaps the most important strategy is emotional governance. Financial elites design rules, routines, and environments that prevent emotion from dictating action. They know that fear and greed cannot be eliminated, but they can be contained. By pre-committing to behaviors limiting exposure to noise and anchoring identity away from outcomes, they protect psychological capital. Long-term wealth requires not just financial endurance, but emotional endurance. Over time, these strategies produce a distinct pattern. Progress appears slow, even unimpressive for long stretches. Then, almost quietly, wealth reaches escape velocity. Outsiders attribute this to luck, timing, or brilliance. Insiders recognize it as the delayed effect of consistency. Long-term wealth is rarely built by dramatic moments. It is built by refusing to abandon sound principles when nothing exciting seems to be happening. And it is precisely here, where most people become impatient and search for acceleration, that the final distinction begins to emerge. Because understanding long-term wealth strategies intellectually is easy, but living them through boredom, doubt, and social pressure is extraordinarily difficult. And this raises the deeper question of how financial elites structure their lives. Incentives and identities to sustain these strategies not for a few years, but for an entire lifetime. And it is from this unfinished thought, deliberately left hanging between method and endurance, that we now need to continue as the sentence carries forward into the next part, where the behavioral systems and personal standards that make long-term wealth possible are finally examined in full. And it is here at the intersection of method and endurance that the true architecture of long-term wealth finally becomes visible, because strategies alone do not carry people across decades. Systems do. Financial elites do not rely on motivation, intelligence, or market conditions to stay disciplined. They design their lives so that discipline is the default, not a daily struggle. This design is subtle, personal, and often invisible. But without it, even the best strategies eventually collapse under pressure. One of the most important systems they build is constraint. Long-term wealth builders deliberately limit their own freedom in specific areas to protect freedom in the larger sense. They impose rules on leverage, position size, spending, and time allocation. These rules are not negotiated during moments of excitement or fear. By restricting choice in advance, they reduce the risk of emotional decisions when stakes are highest. What appears as rigidity from the outside is in reality a carefully chosen form of liberation. Identity management is another foundational system. Financial elites are acutely aware that identity is one of the most dangerous forms of leverage. When someone begins to see themselves as the aggressive investor, the genius allocator, or the always right operator, their future decisions become hostage to that image. Long-term builders resist this by anchoring identity to process rather than outcome. They define themselves as disciplined, patient, and adaptive, not as winners. This allows them to change course without humiliation when reality demands it. Environment design also plays a decisive role. Financial elites shape their physical, informational, and social environments to support long-term thinking. They limit exposure to constant market noise. They avoid social circles that reward bravado or short-term performance. They create routines that encourage reflection rather than reaction. By controlling inputs, they indirectly control outputs. This environmental leverage is one of the most underestimated tools in long-term wealth building. They also structure incentives carefully. Many financial elites tie their compensation ownership or performance evaluation to long-term outcomes rather than short-term metrics. This alignment reduces the temptation to sacrifice durability for immediate gain. Where misaligned incentives exist, discipline eventually erodes. Those who endure either fix the incentives or remove themselves from the system entirely. Another critical system is feedback. Long-term builders seek early, honest feedback on their decisions. Journals, postmortems, and trusted critics help them identify small errors before they become large ones. This feedback is not emotional, it is structural. It allows learning to compound without the tuition of catastrophic failure. Over time, the absence of blow-ups becomes the most powerful signal of success. Long-term wealth also requires a mature relationship with boredom. Financial elites accept that most of the journey will feel uneventful. They do not confuse inactivity with incompetence. They recognize that waiting is part of the process, not a failure of it. This tolerance for boredom protects them from overtrading, overexpansion, and overconfidence. Many fortunes are destroyed not by bad ideas, but by the inability to sit still. Reinvestment discipline is reinforced through lifestyle design. Instead of allowing income growth to automatically translate into consumption, financial elites create intentional friction around spending. They delay gratification, not out of deprivation, but out of strategic patience. This allows compounding to work uninterrupted during the most powerful years. Later, when wealth is more secure, they expand lifestyle without jeopardizing the system. Another often overlooked system is social calibration. Long-term wealth builders choose peers who normalize patience, prudence, and long-term thinking. Being surrounded by people who chase short-term wins increases the psychological cost of discipline. By contrast, communities that value durability make restraint feel normal. This social reinforcement reduces internal conflict and strengthens consistency. As decades pass, these systems begin to converge. Decisions become fewer but more consequential. Complexity is reduced rather than increased. Risk is taken selectively and intentionally. Wealth grows not because of constant action, but because of the absence of destructive behavior. This negative capability, the ability to avoid doing the wrong thing, is the final and most powerful edge in long-term wealth building. And so the story resolves into a paradox that financial elites understand intuitively. Long-term wealth is built not by maximizing returns, but by minimizing regret. It is built not by chasing opportunity, but by designing a life that allows opportunity to arrive without panic. Those who master this architecture stop asking how to get rich and start asking how to stay wise, patient, and solvent over a lifetime. If this exploration of long-term wealth strategies has clarified what truly endures, I invite you to subscribe to the channel and continue these deep reflections together, and leave a comment sharing which system, constraint, identity, environment, or incentive you believe would most improve your own long-term financial outcomes, because the quiet decisions you make today about structure and discipline will matter far more than any single market move ever could.